Hey, what's going on, guys? It's Chris with Life 180. I am here with Garrett, Gunderson, the GOAT when it comes to explaining this whole life insurance stuff. So we just got done filming what was supposed to be a 20-minute video, and it ended up being an hour. Apparently, we talk a lot. But here's the deal. We're talking about all of the different ways that whole life insurance can help you, and we get technical, we get philosophical, we have a lot of conversations about a lot of different things. So I really, really encourage anybody that if you're an agent, if you're somebody who's looking to get a contract, you got to know this stuff. Like I'm kind of on a mission right now to get everybody to just like dive deeper. There's so much marketing on TikTok, on YouTube, on Instagram with all the short form content. And there's too much marketing and too little education on this stuff. So that's why I'm super excited to be here with you talking about this, because we really do the deep dive. And I guess that's what's inspired these long form content videos today. So you can't get through this. It's not the simplest thing, right? It's an overhaul in so many areas of life. And so hopefully you enjoy the video. If you haven't already, subscribe and hit the bell, and have fun. See you.
Whole life. Is it a hole you throw your money into? That's what I was told when I was 18 years old. I thought, well, that's stupid. I don't want to throw my money in a hole. And then I threw it in an abyss, which was called VUL. I like to call that very ugly life, but it was called variable universal life. So I had this negative connotation around it. And honestly, I sold it from like age 19 to 25 and sold it pretty well. But I was always just a little bit like, oh, well, I got to bring it up. How do I bring it up? Not like, yeah, I'm an advocate for life insurance, but not most policies. And I understand why some of the people like Susie Orman and Dave Ramsey and those people hate it, because for the most part, the way most people do it deserves to be hated. But it's amazing that people are now throwing out the baby with the bathwater and missing major opportunity on all these different phases of their life. So if you've been watching some videos recently I've been doing around the topic of life insurance, you might be saying to yourself, great, he's shitting on a bunch of the problems and just pointing out the problems. Well, let's get to the solutions. So I brought Chris here, who is really good at shitting on the problems as part of his brand, and willing to debate anyone that has any level of influence anytime on these topics, because he had to go through the process of selling the garbage himself to discover what was really behind all of it. So whole life, started my first policy when I was 19 years old, $50 a month.
Awesome.
Second policy, $262 a month. And today I just got word that I'm got another policy coming, and so
Congrats.
I'm excited about that. Got a good rating, which allows me to take a reduced policy somewhere else, so I don't have to pay the high rated policy, because I bought that one coming off of 2008, 2009, massive stress, gained a bunch of weight, got my gray hair, was short at the time.
I know.
Short hair with shaved head. I look mean. People are like, dude, you just look mean and intense. And what was interesting is I just was growing my hair, not because of any other reason than I was busy and I wasn't thinking about it. And I went to speak at this event. It was the 5th time I spoke at the event. And more people came up and talked to me than ever before. And I was like, oh, I think it's because my hair.
Your hair
is
more
not
approachable.
I'm not shaved looking like I'm going to hurt someone.
Wait, what do you say?
Well, mine was like just shaved. And the reason was, is because I could just go do it in my garage. I was just all about, like, in my early years, I was a bit of a penny pincher. Was part of it. I've healed from that. My wife likes to tease me about those years, and was patient enough to stay with me through them.
God bless her.
She's like, so I remember telling her, I want to have this much money in savings before we talk about having a baby.
That's always a fun combo.
3 weeks later, I had that money in there because I had closed some big cases.
Oh, no.
And she was like, how much money are we making? Because we lived in this apartment that wasn't very nice, and I was always bitching about, why is our heating bill so much, and why is the air conditioner always on in the
Turn the
in the
lights
summer off. And now I look at, like, I just got notice of what our electrical bill was last 30 days. I was like, that would be like 5 months at that other place. And I was pretty unfazed about it, especially it was like the hottest part of the year. So anyway, I had this negative connotation around whole life initially, but then pretty quickly when I saw how problematic variable universal life was, I became much more open to it, especially was glad that I learned about it in 99, because then 2000, 2001, 2002, it would have been a lot more destructive if I was unfortunately selling like a variable life policy. So anyway, let's talk about why whole life and what the benefits are, what the problems are, and why you might want it at different phases of life.
Yeah. Yeah. Go ahead.
Go ahead.
No, yeah. I think for me, I think that's the place to start, is not what it does. I think too many people, when we talk about life insurance, whether it's whole life or IUL or any of them, but like specifically whole life, it's not just about the cash value. It's not just about the savings. It's not infinite banking. It's not, any of the kind of marketing stuff that's happening that I'm guilty of. You're guilty. Like, we all kind of do it.
Well, and by the way,
to an extent,
we have more people that think positive about it today than when I started in 1998.
Absolutely.
Like, if you talk about it, there's a high chance that someone thinks, well, they're like, oh, yeah, I
certainly a better chance.
Well, I'm talking way better chance.
Way better chance.
Way better chance.
Yeah.
There's still like Wall Street has this story of like, oh, yeah, you want to do that boring. Why would you do that? Like, it's kind of, that was their, like, hey, we got like, why would you go with a Pinto when you have a Ferrari? That's kind of their messaging about that, and the sophistication of Wall Street and all that kind of thing.
Well, I look at it as I never like to sell products. Obviously, we always kind of have to use products at some point in time, but it always has to start with, like, why do we want it? What are our objectives? Like, what are our goals in life? What are our values? What do we believe we need? What do we believe we want to accomplish? What do we want to leave to the next generation? How do we want to leave? What is Scott Donnell was talking about with the gravy stack? He was like, it's not what we leave our kids, it's what we leave in our kids that matters the most, right? And I remember hearing
heritage, not inheritance.
Yeah,
that was
like
a
that.
Great statement.
Those things are huge, right? And so I think
check out Value Creation Kids. That's his book.
It's amazing.
And even check out Gravy Stack and get your kids to go use it. It's awesome.
Yeah, absolutely. And so actually, we just set that up for our kids, and we're doing that whole program.
He was just in my house a couple days ago.
Oh, it's amazing. Yeah. I love that guy. So
with our friend Caleb. He was there too.
Nice.
It was fun.
That's amazing.
On my birthday, a little surprise.
Rock and roll.
Yeah.
So I think, if we work it backwards, let's not talk about products. Like, let's not even talk about whole life. Let's kind of remove it from the equation. At the end of the day, we have different needs at different phases of our life. That's kind of the way I look at it, right? And as we go through life, those needs are going to change drastically, and sometimes they change very quickly, right? Like, our needs are going to vary wildly. And so when we're in our 20s, I was young, I didn't have kids, I wasn't married, I didn't really have any need for life insurance, right? Like, but what did I need? I needed to save money. I didn't do a very good job of this, by the way, when I was back then, but I wish I'd have known this, right? Like, okay, you got to save money, start saving now. It's like, the younger you are, the more risk you can take is kind of the biggest lie that people are told. And so you go back into your 20s for most people, and they're just sitting there not saving any money. They're just taking wild risks, putting all their money in Bitcoin and crypto, or like altcoins and all these things that they have no idea about. They have no control of. They haven't taken the time to actually build a financial structure that's preparing them for long-term success. And so it's like a roller coaster ride. So I think it's really important to kind of like save money, right? And your need to save money is super high. And I think, let's face it, I don't know about you, when I was in my 20s, I wasn't the most disciplined person. It actually shocked.
I was too much so.
You were? Okay,
well,
cool. So I was
too much of my income went into savings.
I was like playing poker
not enough for a lifestyle.
Traveling around and being a lunatic. But
I then gave a lot of it back by buying too much real estate. So it was really
fair
great.
Enough.
At least you got to play a game. I got real estate, which meant I talked to banks and attorneys and property managers and maintenance people. Not the best part of my life, honestly.
Stress.
So
yeah, exactly. So I just look at that, but then, okay, we go through our 20s, we want to save, and when most people in their 20s are not the most disciplined, having some kind of structured savings plan is beneficial, right? So, okay, once again, not talking product, but having something like that would be beneficial. When you get married and you start having kids, okay, now you have different needs. You have, like those change. And then we get through the phases. The kids grow up, they go to college. We have different needs when they're out of the house. And now we hit retirement. We got to start thinking about income. We got to start thinking about retirement, and cash flow and all these things at that point in time. We have to start thinking about declining health. We got to start thinking about legacy and generational wealth and like, what are we passing on? How are we doing that? What what are the estate taxes going to look like? What are the, like all that stuff. And so I don't know about you, but like when I break it down and I look at, okay, well, let me put it this way. A lot of people in our industry like to use the phrase like, get your dollars to perform multiple functions, and like, okay, that's great. It sounds good on a like napkin or like a, on a marketing phrase or whatever. But what does that actually mean? How does that work? And I think a lot of times people are utilizing that phrase in the terms of like, you could borrow your money, and they're talking infinite banking kind of stuff and like falsely talking about positive arbitrage and all these things in policies. And like, they're focusing on the wrong things, right?
Right.
I look at it and I go, well, we're talking about all these different needs in life. I don't know of another asset when we back it out, since we're talking about whole life, that will actually accomplish all these things, right? That at every stage of your life, it solves a different need all in one product, right? And to me, that's getting your dollars to perform multiple functions.
Mm-hmm. And I look at it like we should consider automatically saving than deliberately investing.
Absolutely.
And unfortunately, those terms have been collapsed and confused. So people will be like, oh, I'm saving money in my 401k.
Ooh.
No, it's not a savings account. That's usually invested in mutual funds.
Yep.
It's not something that's easily accessible without restrictions and penalties and things that way. So when people are saying that, I like automatically save, and I look at like cash value in a whole life policy as savings, not as an investment.
Right.
I look at it as an alternative to bonds, but B, I want all the benefits that can come along with that now and in the future.
Sure.
So, I mean, I go deeper. I don't really feel comfortable with the state of banks right now.
Talk about that for a second,
Yeah.
though. Talk about the difference between saving and investing, because I think a lot of people are told you need to save for retirement. Nobody is saving for retirement.
No,
right? Like,
that's an investing strategy.
Right.
And usually with retirement plans that skip important steps.
Yeah.
So let me tell you the important steps. When you automatically pay yourself first, where it goes into some type of savings or liquid account, I call that wealth capture.
Sure.
And then the next step in that is, how do you enhance that account without destroying your lifestyle?
Yeah.
It comes through efficiency. So the second step of my kind of wealth framework is, where can we save tax, interest, investment fees that are non-performing, or insurance coverages that aren't helping?
Yeah.
So anything inconsequential or duplicate coverages or improper structure. So
Yeah.
use that efficiency to enhance your savings. But then enhance your savings by moving from wealth capture to wealth creation, which to me is using an overfunded whole life policy.
Sure.
Now, in the short term, you're going to be worse off.
Yeah.
From a cash perspective.
Yep.
Way better off from a benefits perspective, but not necessarily something that you're likely to use in the short term. So then when you have that cash value, that starts to become something that creates a lot of sustainability and stability when it comes to your finances, because in a lot of states, it's protected from liability and bankruptcy fully. Some it's partially protected.
Yep. If
something happens to you, this money comes in tax-free to your spouse. And I bought my first policy before I was married.
Yeah.
Because I just thought, I'm probably going to get married. And even if I didn't get married, I have causes that are important to me.
Sure.
And my legacy isn't just within my bloodline. Right. So that was part of the thinking. And then I've used my cash value for the very thing that we're sitting in right here. When it was very competitive to get this property, I said I can close in 9 days. And I was able to get money from my policy to close on the property. And the other two people that wanted it, they needed to go finance.
Yep.
So that was helpful. Now, I went from 2015 until probably 2020 without touching my cash value once. But I felt comfortable with it because I was growing my business and didn't want to spend time on other investments outside of my business.
Right.
So I knew that, hey, it's not sitting in a 1%, savings account, because that's what it was back then.
Sure.
And I'm funding it where, it's probably going to get 4% or something. I don't know.
Yeah.
I mean,
Yeah.
I've had some get more, some get less, depending on the time frame we're looking at the policy. And I found a way to fund it through tax strategy primarily. So it wasn't infringing upon my lifestyle.
Yep.
So I took this tax strategy, and with those dollars, I then put it into the policy as a way. I looked at it as like a medium storage unit for my money better than like not as good short term as just putting it in a savings account, but way better than a savings account in the medium term. And long term, this is where I really look at it is I'm buying my death benefit, and that's my net worth, and building cash flow. So this is the next part of the framework. Most people are trained, taught, and indoctrinated that they should set money aside for 30 years or longer so they can retire. And underlying that notion is you could do things that you hate and sacrifice and scrimp and do all this because one day it's all going to be worth it when you live your retirement dream. Yet 95% of people, according to the U.S. Department of Labor, at age 65 are not financially independent.
It's
so
insane.
they're delaying all this, not enjoying life fully. So they're doing things they hate to one day finally live the life they love when they might not have the money to do it, or it might be too late because they're not healthy enough because of what the deterioration of their life was from living the. So my next part of my framework is create financial independence by investing for cash flow. So save, and now when there's opportunity like this, use that cash to acquire assets, because the best time to acquire an asset is when there's distress. Like there's economic turmoil. And what happens there is during economic turmoil, everybody that's in the market goes, well, if I sell now, it's a loss. And so their advisors saying, you got to stick with it. The market always comes back. And so the time when the best deals are for acquiring a business, for acquiring real estate, they're out of the game because they're being told to look at a 30-year horizon and not consider the losses that they have, or not. Like I had a client in last year, 2022. Called his advisor because he had lost $600,000 of his retirement savings after selling his business. And said, I want out. And his advisor said, this will be the biggest mistake you've ever made. And I was like, well, actually, I think the biggest mistake was going with his advisor after retirement. Like, and then he saved $800,000 of future losses at the time he got out. Because it got a lot worse when interest rates really started to climb. So, but he felt he had no cash flow control. He had I call it having no control over the outcome of your income. Because now you're like, okay, well, what are interest rates doing? What's my accounts doing? And, you know, and dude, even worse, he had his house paid off, and his advisor told him to refinance it and pull all that equity out and put it in the market where he already sold his business for 8
So he did that. He followed that advice. Oh my God.
For 8 figures. It's egregious. But here's the deal. I want financial independence where you start creating cash flow with your assets so that when that covers your basic expenses, you have choice in life.
Absolutely.
That financial independence allows you to say, well, what if you want to take some time off? What if you want to go on the vacations now for a shorter period of time instead of waiting till one day? And then here's the real advantage. It means every active dollar you earn, if your recurring revenue or your cash flows covering your expenses from assets, could build more assets. So rather than trying to save 10% of your money to try to get 10%, which will never happen in the stock market, and wait for 30 years, you could say, well, what if I was financially independent in 3, 4, 5, maybe 10 years at the longest with the right framework? Then I can reinvest in that framework, but it comes from investing, not saving. Cash value is your savings, and then you pounce on the opportunities when they're there, maybe like me, sitting for 5 years, doing nothing with that cash value. But the asset I bought in 2014 was a business that really performed, that I sold for more in 2021 than what I bought it for. And more than what the market performed in that bull run during that time. So it's more about that financial independence after you've automatically started saving. Save a certain percentage of your income, which I recommend 18%. There's a reason why. Find the 18% through either the IRS, interest, investments, or insurance.
Inefficiencies.
Inefficiencies. All inefficiencies. And then build that account up when you have enough there. Then focus on becoming a cash flow investor. And my 3 legs are either intellectual property, businesses, or real estate. I completely avoid the stock market. I have nothing in it because it's not a good cash flow tool. And it's also something that most people don't understand, yet they put their money there. So it puts them in a reliance of something that they have no control over. And yes, I've made mistakes with businesses. I've made mistakes with real estate. I haven't made too many mistakes with intellectual property, thankfully. But some has performed better than others.
A little easier to manage the intellectual property to an extent.
Because it's what relates to me. But when people figure out their investor DNA, which is the key to these 5 components to financial independence, which is recover cash, engineer wealth. You talk about
Yep.
what's the monthly amount. Let's reverse engineer and figure out what it's going to take to get that monthly amount. Is it paying off loans?
Yep.
Is it building assets? Then the third step is accelerate investment income, which is cash flow. The fourth is scale revenue. So if you work in an enterprise, find out ways that if you contribute to the bottom line, you can participate on upside. Or if you're an entrepreneur, it's what things can you make an adjustment to that give you exponential growth. So it might be stop funding a retirement plan and instead hire someone or do a marketing initiative or add technology, right? And then the fifth one is to make it count. Like treat yourself as your greatest asset, not a stock, bond, or piece of real estate. Invest back into you and enjoy your life along the way so you don't get burned out and don't basically create a life you don't want to retire from. And that's the framework. Now, whole life is a big part of that framework because for me, it's risk minimized capital. It's not fully risk-free, but it's as risk-free as I know to put money into.
Agreed.
I have access to it. There's tax benefits. And ultimately, when I'm older, I can use the death benefit to my advantage to be more charitable. But in being more charitable, increase my cash flow 20 to 50% on the assets I'm charitable with without disinheriting my family.
Key point.
I can use it as a tool to accelerate the pay down of other assets and replace that to not disinherit my family. Because I think it's weird when people I'm not leaving my kids an inheritance, but I'm leaving them an opportunity fund that they could tap into so they don't have to use the banking system. I actually just talked to this guy, Ryan Thacker. And so Ryan, he sells a lot of life insurance. He has like a bunch of offices here in Utah. And he talked about how he got into it was he was going to buy some real estate. It was an amazing deal because the person was going through a divorce and someone came in and closed in 5 days and he was going to finance. So he's an intelligent guy. He sat down at lunch with the guy. How did you close so fast? He goes, well, my grandfather started an insurance policy that now has $40 million of cash value.
No way.
And we just use it to buy deals when people need money quick.
That's amazing.
And I call that making money on the buy. Distress, disenchantment, that kind of stuff, divorce. Like my friend Rob Follows has a 6D model, which is, and most people would just lose everything. So you can actually come in and give them something so they can have some profit, which helps them. You're not just preying upon them. Like, oh, great, I got all your money.
Of course.
Like how many businesses just go out of business that could have sold with some customer list, with some, but they wait too long, don't talk to someone. And so someone that has cash can really help someone
more
in a
now
burdened
than
situation.
Ever.
Right.
More now than ever.
And so that's my framework. And the reason I use whole life is I know that they can't ask me to put in more premium. I know that my cash value has a minimum guarantee, and once the dividend's paid, it's there. I know my death benefit's going to be around 1 day longer than me, which means it's going to come into my family. Right? And ultimately, I have all these provisions to use the cash when the time is right. And so if my other assets aren't performing as well, I can use my cash to smooth those years out. And then wait for them to come back so I'm not destroying the value of other things. I mean, there's 100 things to talk about. So that's my ideas.
I love that, man.
What are yours?
Well, so everything you just spoke to is, first of all, it's amazing. I think the principles of what you are speaking to are absolute. Like, I think, you could debate anybody, since we're talking about debate so much, like on the concepts.
And most planners are all about setting money aside and accumulating, not creating cash flow. So it automatically puts me in a situation where we have a totally different viewpoint for people to choose from.
But you're right. I mean, like, that's great. And you spoke a lot about wealthy people, right? Your guy with $40 million in his family whole life policy kind of deal. That's great. I have a real passion. I mean, first of all, that's amazing. And we love to help people like that. And, those people need less help. And it's about like accelerating what they're already doing or improving what they're already doing. There's a big segment of the population right now. Like you said, 95% of people are getting to retirement and not financially independent, right? And so why is it? We talked at a break when we were doing all these videos about The Ant and the Elephant, the book, right? And I think there's a big thing going on right now about the system is not set up for you to succeed. The system is set up for you to be controlled. And I know that's kind of a bold statement for a lot of people to hear, but it's what I believe to be true. And I think when you look at it, The Ant and the Elephant is this fable about the power of the subconscious mind and the fact that if you don't believe that you're going to be successful, you can't just white knuckle and grit your way through it. It's like when you make a conscious decision, you have 4 million neurons firing off in your brain. When you make a subconscious habit, when you're just reacting. There's 4 billion neurons going off. So it's the concept of thinking that like, hey, I'm just going to lose weight for the sake of it, and just being disciplined with a diet, or I'm just going to do the work, or I'm going to make the cold calls, or I'm going to do whatever. Like if you don't believe why, and you haven't reprogrammed your subconscious mind about why it's so important to you, you're the equivalent of an ant sitting on the head of an elephant thinking you have the ability to steer where that elephant is going, right? And so I think right now with the world that we're living in, if you look at the environment, and you're much more philosophical, and I'm, I get really spreadsheety, nerdy in that stuff. And I look at this and I go, we're thinking about a time frame 30 years from now. Let's say for me and people in our general range, 20 to 30 years. Do you have any clue what the world's going to look like in 25 to 30 years?
Man, I can't imagine. It's moving so much faster than it used to.
It's nuts, right? And so to think about this. Some financial planner is telling you that you need to take your $100,000 of household income, let's just say for on average or whatever, and they're going to say, all right, they're going to use the 4% rule, and they're going to say, all right, for you to be able to retire and maintain your standard of living, let's assume there's no Social Security or anything of that nature, you need $2.5 million, right? With a 4% rule, that's going to get you to $100,000.
And the 4% rule, say what that is.
So the 4% rule is basically saying that you can take a 4% distribution from
without destroying the value of your portfolio,
without running the high risk of running out of money while you're alive.
So everybody knows what investing is.
Yeah.
But not everybody knows what disinvesting is.
Right.
And it's that distribution phase. Yep. And if you go higher than 4% due to volatility, you risk losing your principal.
Correct. Exactly. And so with that said, that's you're planning on that right now, but that's for today. Now, but you're not planning for today. You're planning 25, 30 years from now, right? Mm-hmm. And so now we take in inflation into consideration. Most people don't realize if the target rate for inflation is 2%. The actual inflation, according to the CPI and actual numbers, which I think it's actually worse than this, but it's just over 4%. And so if you think about 4% inflation, if you make $100,000 right now, you're going to need over $300,000 a year of income just to maintain your standard of living.
Let's go back in time.
Like, think about that.
When were you born?
1980.
Okay, 1980. If someone talked to your parents in 1980 and said, what's a good amount of money to have for retirement? What do you think they would say?
My parents, I can tell you back then, my parents combined were making $26,000 a year.
Okay. And so what's the biggest number they probably would have thought?
$250,000.
Right. So if we went and interviewed people making $100,000, which would have been a lot more, and we said, what's a good amount of money to have for retirement?
And they would have said, for $100,000 back then, I mean, because everything was different back then.
They might say who's
maybe $1 million.
More than $1 million?
Yeah, nobody,
right? They
especially back then because interest rates were so high that the whole game has changed.
So basically, they are so ill prepared if they tried to hit their target because like in 1980, what's a dollar worth in 1980? What's it worth today?
It's
due to inflation. $1 today would have the purchasing power, like it would be
probably 4 to 5x now than it was back then.
Yeah, so like at 20 cents maybe, right?
Yeah.
So $1 then would spend like 20 cents.
Yep. If not worse than that, but yes.
Right.
But yeah, it's really horrible. Like when you think about it, this is the traditional financial model that people are told, go to school, get a job, put money in your 401k, invest in a Roth IRA, but invest and save, squirrel money, try to accumulate for 30 years, 40 years.
Put it in a diversified portfolio, rebalance.
And at the end of the day, hopefully you'll be there. But that system is failing. And I would argue right now that it's a failing financial experiment. And I say that, and a lot of people are like, what people think about as traditional plans, like a 401k. Guys, I'm older than a 401k.
Right, and think about it. 1980, what was life expectancy versus today?
Yeah, I don't know the answer, but it was less.
Right, it was less, and especially if you take out suicide today, because we've had the first time in a few years where we've had a decline, and a lot of it is, some people want to say it was COVID, but it's actually suicide that is one of the major things because it doesn't get talked about and reported on the news and that kind of stuff because it's a pretty sad state, and pretty hard, but like.
Well, it's indicative of the culture problem that we live in.
People are living longer, but they're living sicker.
Totally.
So people in this movement, like the FIRE movement, right? they want to retire at 50
Yep.
and live as frugal as possible.
Mm-hmm.
But living too frugal might mean that you're not eating as healthy of food.
Mm.
I mean, there's a lot of factors that go with that.
Yeah.
Like we know insurance companies have enhanced dividends for people that buy a certain size of policy because wealthier people live longer.
Mm-hmm.
They have better access to care.
Mm-hmm.
I mean, it's like, that's just, I'm not stating
Sure.
anything other than what is in the documents here.
Yeah.
Right.
Totally.
And so what happens is what if you're in retirement for 40 years where maybe in the past, like when Social Security came out, the entire plan was it was an industrial age and they were only going to have to pay for a few years.
Yeah.
People were dying pretty early. I mean, if you worked an assembly line 7 days a week, or you worked in mines, or you worked in like there wasn't the technology we have that reduces some of that burden. So people are, at 62, they're going on Social Security, they're dying at 65.
Yep.
Now they're living to 90, but how healthy are they? So like it really is a major burden to a portfolio. So this notion that I can live off 70% of my pre-retirement income is dangerous.
Super dangerous.
Because of inflation, because of propensity to consume and technology and all these factors and longevity.
And health risk. I mean, like people don't take into consideration the fact that your medical bills in retirement are probably alone going to supersede all the other savings that you cut out.
Especially in America,
Yeah.
where it's extra expensive due to insurance,
Yep.
due to health insurance,
Sure.
really driving costs up. So here's
Yep.
the thing. If you don't create financial independence before retirement,
Mm-hmm.
you'll be ill-equipped and ill-prepared to handle retirement. Because if you can create it beforehand, you can make adjustments. Because it's not like it's a static thing. Like I'm economically independent, everything's perfect.
Mm-hmm.
You can have a change in interest rates. You can have a change in taxation. You can have a change in inflation.
Yeah.
Those three culprits can really change. But now you can make adjustments because you can say, oh, I was financially independent, but I'm not. So what's the next step to get there? But if you don't and you're just accumulating, and now you get to retirement, you're like, is this going to be okay? So this is why I want a whole life death benefit.
Totally.
Because I need some buoyancy. And if I have this resource, and in What Would the Rockefellers Do, I wrote 6 different ways the death benefit can actually help you while you're alive.
Cool.
Right. And I learned some of those from Leap, and I learned some of those from, just my own like thought processes.
Sure.
But like, that I think is one of the game-changing pieces of the book, is if you can really understand that. So look, we've identified at least the framework here of pay yourself first, automatically save, be efficient so it's easier to make that savings and not destroy your lifestyle.
Yep.
Move from savings accounts to cash value, which is a little bit more medium term, takes a little bit of time to build. Then become a cash flow investor and use the 5 levers that create economic independence.
Yep.
Right. And then from there, know your investor DNA, so you're choosing the right investments that are aligned with who you are versus just trusting someone else that doesn't create cash flow. And that's
by the way, if you do all the things he said to get to that place, to know your investor DNA, you'll learn your investor DNA through that entire process.
Right, because your investor DNA is very unique in that you have a mind that you are a professional poker player.
Yep.
Right.
Yep.
You are in product design.
Yep.
Like you have a certain way to look and dissect things and understand where there might be arbitrage or ways to capitalize. I'm going to invest in different things because of who I am, but then we have this similarity of content creation.
Yep.
And helping cut through. So,
Absolutely.
So anyway, the next, look, if you're enjoying these conversations, we're going to dive deeper into this whole life conversation and answer, is it a hole you throw your money into, or is it something that can actually really help you to get a lower risk adjusted return than bonds? But it's a savings tool, not an investing tool. When people compare their investments to their insurance, they're neglecting to understand the benefits of it and the access along the way and the protections that come with that as well. And so that's where we're headed. Any final sentiments?
Yeah, I would say that that's key. And I think the one thing we didn't touch on, or really, I guess maybe we breezed over it, was the living benefits component in retirement and the fact that it's inevitable. Like, I know we talk about death benefit being inevitable. I would say it's almost inevitable. Very few people go to sleep one night, close their eyes, and pass away, like fully healthy with no medical issues and no need for any kind of treatment. And one of the things I'm really passionate about because of my own personal stories and my family and whatever is the fact that you have complete control of your own medical directive. So you don't have the medical system and insurance companies and all that hounding you and
telling you
dictating
what you can do or not do.
dictating to you how you're going to be able to handle your own life. Like,
yeah,
that's empowering. And there's no other asset that I look at that does all these things for you. So, yeah, that's what I would say.
All right.
Thanks, guys.